natural gas futures staged another rebound on Friday, hovering just above the 200-day moving average as traders look ahead to December options expiry on Monday and final settlement on Tuesday. The market is tightening around this major technical threshold, and the way prices react to the 200-day will likely define the tone and direction as we move into next week. The January natural gas contract is trading near $4.72, but when you line that up with real-time storage data, projected inventory balances, and the current supply-demand outlook, the pricing looks noticeably stretched. The December front-month contract appears overvalued by roughly 68%, and even January, supported by seasonal demand and early winter heating expectations, still looks overpriced by about 33%. European benchmarks tell a similar story, underscoring how far U.S. futures have drifted from fundamental value. If January ultimately trends warmer than current forecasts suggest, the market's premium becomes even harder to justify. In that scenario, the downside potential grows significantly, and a correction toward the estimated fair value zone near $3.24 becomes increasingly plausible. And honestly, this is exactly why natural gas earned the charming nickname the Widowmaker. So let me gently caution any fresh, bright-eyed traders out there, this is not the playground to take bold, life-altering risks unless you enjoy learning lessons the hard way. Meanwhile, weather analysts continue to call for very light consumption through November 26, with much of the U.S. running well above normal temperatures. A colder push is expected to move into the Rockies and northern plains by the middle of next week, yet early December forecasts remain inconsistent and highly changeable. With the patterns still lacking firm direction, traders are keeping their positioning flexible. Overall, weather models have trended colder from November 28, but near-term demand still looks soft. Meanwhile, the latest gas rig count, released at 1 p.m., came in at 127 rigs, and that number speaks volumes. It's a clear signal that producers are not only confident but aggressively committed to boosting output. When drillers keep stacking rigs at this pace, it usually means they see enough margin in forward demand to justify expanding operations, and they're moving decisively to capitalize on it. In short, the production side isn't just active, it's leaning in hard, reminding the market that supply growth remains a force to be reckoned with. From a technical standpoint, the market is currently perched just above the 200-day moving average, a level that continues to act as the key dividing line for short-term sentiment. If buyers manage to defend this area, the next logical upside targets sit at the recent 2-week high of $4.68, followed by a potential test of the longer-term swing high near $4.72. A decisive break above those levels would signal that bullish momentum is reasserting itself. However, if the 200-day fails to hold, that would be a clear invitation for sellers to step back in. In that scenario, the immediate downside markers come into focus at $4.40, with a more substantial support band waiting between $4.25 and $4.15. On a broader scale, the trend maintains a bullish structure as long as prices remain above the 50-day moving average. That threshold, now sitting around $4.06, continues to anchor the bigger picture. As long as it holds, this market still favors a buy-the-dip approach rather than a shift to sustained bearish positioning. Don't forget to drop a comment, and feel free to buy me a coffee or YouTube super thanks if you'd like to help keep this channel going. Thanks for being here and I'll see you in the next one.